Not really. I mean, you've had negative warning signs since about March last year. So it's not really a new thing, to be honest with you, that Italy's struggling. When we look at the economic data, the surprise indices, so data versus expectations, in Europe it's been rolling over for around a year now. And that was one of the key things that made us bullish on the dollar last year, was that Europe suddenly looked a lot worse than expected. And that hasn't shown any sign of relenting. The data continues to come in worse than expected. It's incredibly difficult to see how the ECB does anything in terms of rate hikes. If anything, they're going to have to do more liquidity provision in terms of TLTROs later this year. And actually, it's just a simple case of why would you want to buy the euro at this point in time when you're having to pay for the privilege of doing so? You've got those negative growth risks. You've got all of the political risks that we talk about on a daily basis, it seems. For us, euro dollar is a one-way trade lower, really.
And the problem is, I think, as illustrated by that chart, and it's a point that you often make about just the lack of real movement in that euro-dollar story in reality. So if you're actually looking for a decent turn over a shorter time frame with more volatility, where do you think the real mispricing is in the market?
Well, I think there's a few different places where the market looks overstretched. I mean, down under, Australia, New Zealand, we've seen decent rallies in both those currencies in the last few weeks, really, since the start of the year. A bit of a early year bull market, it seems to be coming in. We see quite often, but ultimately, again, the economics down there looks pretty soggy. We had really bad Aussie building numbers overnight. We've got this Royal Commission on Banking that's suggesting that some of the lending standards might have to be tightened, so putting some pressure on those economies. And the other places we're quite concerned about FX-wise is what we call the fragile four. So in G10, you've got Sweden, Norway, Canada, and Switzerland. So these are economies with big private sector debt, where you've seen a big increase in private sector debt in the last 10 years or so. And therefore, it's going to be incredibly difficult for their central banks to raise rates in any kind of significant way in the next few years. So you've got a cyclical threat, and you've got an underlying structural threat of those big amounts of debt as well.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.